Well, good evening, everyone, and thank you for joining us this evening. This is the first webinar of a series of 4 that we're going to be doing on syndications. And for this one, we're going to talk about, or we're going to break down the basics of a real estate syndication. And I'd like to thank Brandon for joining me. And he has done a great job putting together a lot of this information that we're going to review tonight. But for some quick introductions, my name is Mike Strodtman with Blue Skies Equity. And prior to investing in real estate, I was a city planner and worked on all aspects of zoning and community development. And with that, I quickly realized that I enjoy development, I enjoy real estate, but being a city planner, I'm on the wrong side of the table. I'm grateful for the opportunity that I had because it's given me a lot of insight now in bringing projects and doing projects, and that knowledge base has definitely assisted me when it comes time to working with communities and doing development projects, or even working with the city on an existing project where there needs to be approvals and such. But I've been investing in real estate for 15 years, and I have bought properties that have needed significant renovations, interior and exterior, parking areas. I've also bought and subdivided land, and I've done some ground up construction, and we're closely designing the buildings and working with the general contractor on those. My present portfolio consists of just over 500 residential units, as both a limited partner and also ones that we own and operate on our own. Brandon.
Yeah, thanks, Mike. And thanks for having me. So Brandon Gattay with By Design Capital. We're based here in Rapid City, South Dakota. And like Mike, my background is not in real estate in my professional career. So I have a degree in geotechnical engineering and construction management. And the majority of my professional career, the last 10 years, has been in the construction industry, in progressive project management and leadership roles. Most recently, as a senior executive in a large national construction firm, leading a business unit and leading a team of project managers. I've successfully managed an operating budget of $40 million annually. And like Mike, taking a lot of the things I've learned and the experiences I have in my professional career, I learned that those could translate over successfully into real estate, and especially the commercial real estate space, where my experience in managing P&Ls, managing budgets, managing projects translates to the commercial real estate space. On the real estate investing side, I do have 5 years in real estate investing. I started, like a lot of folks, in the single family space. Did some long-term rentals with single families, short-term rentals. I've done private lending, both with private funds and with my self-directed IRA. And in the last 2 years, really have been transitioning almost completely over the multifamily space, specifically in syndications. My present portfolio is right around 300 units, both multifamily and some single family, but the majority of those being multifamily, and a lot of that as a limited partner, which we'll be talking about tonight. So while I am an active investor as well, and I do sit on the owner side, a lot of the perspective I'll bring tonight is through that limited partner perspective, investing in other syndications over the last couple of years.
Just as a quick disclaimer, the information that we're going to provide this evening is for informational purposes and does not constitute professional, financial, or legal advice. So, we definitely want to provide you with accurate information, but it doesn't always, the information that we're going to provide doesn't cast the net over everybody. Everybody's situation is different. Every project is different. And especially when it comes to taxes, they can all be different for us. So these are all thoughts and ideas and great information for you to ask questions of your CPA, but definitely seek their advice along with legal advice before jumping in any projects. So what is a syndication? It's the pooling of resources, the experience, the time, and the capital to buy larger projects. when you think about a single family home or even a duplex, if you've invested in those previously and you did it on your own, you can go meet the brokers and look at properties, do a quick underwriting to see if it makes sense on your side. If the numbers make sense to buy, you can go to talk to different banks and secure the financing and do all those items alone. Because typically, the amount of money, the capital to bring into that isn't significant, typically, and for most of us. But if you're going to buy, a 5, 10, 15 or $1 million building or larger, it definitely takes more time, energy, and effort. And we need those partners, different partners, throughout this process. So, a great quote from Warren Buffett is, if you want to go fast, you can go alone. But if you want to go far, we need to go together.
Yeah, great stuff, Mike. And it's really is a team sport. And like you'd mentioned, it's the pooling of resources. And I think we get stuck on when we think of resources as that only being capital, but those resources can be your experience, they can be time, or they can be capital. And like I mentioned, I really started in multifamily through that limited partner space, where at the time I was happy in my career, I had done well, but I was spending 60 hours a week a lot of the times in my day job. So I didn't have the time, but I had the capital. So that's where the syndication really came to me, where I could leverage other people's experience and time, and still enjoy the benefits of real estate investing.
Yeah, that's a great point, and definitely a segue into this slide where we kind of break out the active investor and the passive investor. Because for the active investors, they are the group, the entity, that are involved in that investment. There's various aspects of it. As I mentioned before, there's acquisitions and deal sourcing. You need to go out and find these projects. You need to make sure that they're in a good neighborhood and in a good market. And funding, obviously we need to be able to know different avenues to fund this project and get the financing that's necessary for it. And asset management. Asset management is huge. You want to have someone on your team that has experience with asset management and is able to work with a property management company to make sure that your business plan is met. So there's a lot of different hats to wear. And it's nice when the active investors, that GP group, are able to break these activities apart, and you have someone that's strong in one. Not that we don't all know and have knowledge about them, but it's a lot easier in regards to time, to be able to share these different activities with others in your group. The active investors are also the ones that are liable for the debt. They're signing on the dotted line for that project. And when it comes to being an active investor, it's your time, your energy, and your risk. So for some of us, having that extra time or wanting to spend that extra time just isn't there. And becoming a passive investor can be a lot more beneficial. We hear a lot of times of people that have a great W-2. They enjoy their W-2, although it's, 10 plus hours a day. And the last thing they want to do is come home and start looking for investment opportunities on their own. They would rather invest as a limited partner and be considered a passive investor, where, they're the ones providing the capital in exchange for a target return in that project and over that time frame that is laid out. And we'll give some examples later on. But when it comes to a passive investor, there's no involvement in the management decisions. There's minimal time commitment. We definitely don't want to say there's no time commitment. No, you definitely want to be involved. You want to know who the sponsors are. You want to be able to look at the business plan. You want to be able to see the underwriting and see if this business plan is going to be met. In regards to risk, it is lower risk, but we definitely there too don't want to say that there's no risk, because it's your money, it's your hard-earned dollars as you are going to invest into this project. So although you're not personally tied to the debt, you are putting up capital in wanting to make sure that that business plan is being met.
Yeah, and that's a great point, and one that we'll touch on, both of those, the minimal, not no time, and the low but not no risk. But the risk piece, I definitely think gets overlooked a little bit by newer investors and folks that I've spoken to. And I really want to focus on that. It's the returns of the investment. It is an investment. These aren't guaranteed returns at any point. They're projected returns based off of the performance of the property. Again, we'll touch on that several times, but really want to make sure that that's well understood as you consider investing in any type of syndication or real estate in general.
Next, we'll look at accredited versus non-accredited investors. And also another, for non-accredited, you also hear the word sophisticated. But for an accredited investor, they can invest in a 506c offering. These are offerings where the sponsor is able to advertise it. There is no required pre-existing relationship with that sponsor. We always say, and you'll hear us say it a few times, is no matter what, even if you are accredited, we strongly recommend you know, like, and trust that sponsor before investing in any of their projects. But there's criteria set forth by the SEC to become an accredited investor. And the first one is if you file individually or jointly, you need to have a net worth of $1 million or more. And this does exclude your primary residence. Or you need to have an individual income of more than $200,000, or if you file jointly, $300,000 or greater. And that's at the time of this recording. There's been talks throughout the years that they may change that, but as of today, those are the requirements for that. And in regards to the income side of it, they're looking at more of a little bit of a longer term. It wasn't like 1 year. Maybe you were able to sell some stuff and you were able to had an income of that exceeded $300,000. It's more of a sustaining income there. Non-accredited, you can invest in a 506B offering. I always like to say B for buddy, and we'll see that where we talk about having to have a pre-existing relationship with the sponsor. And again, we call it your buddies, your family, friends. Typically, those are your investors there. You do not need to meet the criteria that we talked about earlier, although you do need to demonstrate that you are able to make reasonable, financial decisions.
Yeah, thanks, Mike. So if you're considering investing in a syndication, what does the structure look like? Like Mike had mentioned earlier, if you're doing single family duplexes, the smaller size things, typically that's you, maybe a partner or two. And it's really simple where you're either just buying the property together or maybe you have an LLC. The typical structure for a syndication is somewhat similar. And this is a very general structure that we're showing here. Certainly can be much more complex on larger deals, but generally speaking, this is what you'll see. So you have the property in question, the asset that you're looking to acquire, and usually there will be an acquisition LLC that's set up that actually purchases the property. The property is held within that LLC. Then you have the two different investor types or partner types, like we've talked: general partners, the active investors, and then the limited partner, the passive investors. Those general partners, again, that's the syndication group. That's those active investors. Typically, there will be a syndication LLC that's set up for that group that owns shares of that acquisition LLC. And then the limited partners, in exchange for their capital investment, they own their own shares of that acquisition LLC. Again, those general partners, they're the ones doing the work. They're finding the property, building the partnership, securing financing, signing on the loan, and really doing all the meat of putting this together. And then those limited partners, again, they provide that capital for down payment, acquisition costs, renovations, any of the capital, the cash needed to really execute on the business plan that general partnership has put together. Again, no active involvement in the management decisions of the asset, and they're provided a return on their capital investment, again, based on the performance of the asset. So the actual execution of that business plan and how the asset performs over the life of the investment. All right, so what does this look like from a timeline? What are the phases of a syndication? And really, you can break this down into three high-level phases. That first phase is the origination or the acquisition phase, and there's very limited involvement from those limited partners at this stage. This is almost entirely the general partnership. They're doing the market analyses, they're finding the deals, and they're doing the underwriting and the analyses on the deal itself. They're putting together that business plan. They're working with banks and lenders on the debt financing. They're structuring the overall entity. And this is where they start to bring in the limited partners, where they're raising that capital or the equity to close on the property. And once that property is then closed and it's acquired within that LLC, funded, that's where you move into phase two here, which is the actual operation. This is where the rubber really meets the road, and where both the general partners and the limited partners are more involved at this phase. So this is really business plan implementation. We're executing on the renovation strategy, increasing rents to market. We're rebranding the property, maybe doing some exterior upgrades to really up that curb appeal, and potentially bringing in new management really to increase the efficiency of the operations there. Again, during this phase, this is really where the involvement of those limited partners really comes in, and you would be getting regular communications from your sponsor team, from that GP team. These can be monthly, quarterly. I've heard weekly for some folks. All depends on the business plan, but this is where you should expect that regular communication to understand how the asset is performing versus the business plan. Really important that the sponsor's not only communicating the good things and how the finances are performing, but you also want a sponsor that's transparent and is going to share when things don't go according to plan. I think we all know that a plan is something you need to have, and they're great, but they're typically wrong the very instant that you put them in place. Things change, and these are longer term investments. You want to have a team that's willing to share the good and the bad. And then this phase is also where you as a limited partner might see cash flow distributions, if there are any. Again, that depends on the business plan, if there will be cash flow distributions regularly throughout the life of the investment. We'll talk a little bit more about that here in the next couple slides, how that might work. But if there is excess profit from just operations, this is where you would start to see those distributions. Then that third phase, the final phase here, is the liquidation phase. So this is the sale or refinance of the property for a profit. On the commercial real estate side of things, and we'll talk again a little bit more here in the next couple slides, but we can, through value add strategies, we can actually force appreciation, which is a little bit different than the residential real estate space. So at this sale or refinance, any of those excess profits there, this then gets distributed to the limited partners and the general partners based off of the structure. And then the entity is typically dissolved at this phase. Again, these are longer term investments, typically 3 to 7 years from the acquisition to the exit. You'll probably most commonly see these modeled out and planned for 5 years. Those are really common, but you certainly can see 3 or 7, again, all depending on the business plan there. And you also want to understand what the contingency plans are from the sponsorship team. If market conditions change, it may be planned for 5 years, but they may need to extend if the market shifts, or they may look at it and the market has improved. They may exit sooner. It's good to understand what those different options are with your sponsor team.
Yeah, no, you did a great job of explaining that, because or the business plan, and that how it can change. And when we look at that investment timeline, that 3 to 7 years, and having flexibility, like you said, sometimes things are going really well, and you can have someone come in and offer you and want to buy that asset from you and offer you the money that you projected to get in year 5, but wants it in year 3. So the sale may happen earlier on. Otherwise, if interest rates change and purchase prices come down, but you do have your funding is set up so that you're able to hold that property longer, maybe hold it until 7 with the thoughts that the interest rates will come down, which will bring up the price or the value of your asset. But yeah, being flexible with the business plan and the diversity of that business plan from project to project will vary different. But no, it's a great way to lay out those 3 phases.
All right. Yeah. Now the fun part. How do you make money as a passive investor if you're that limited partner? So there's really 3 main ways that you as a passive investor can make money. First one being through cash flow. Again, this is during the operation phase. These excess profits just from the operation of the property and the business plan, these get distributed out to the investors based off of those splits and things we'll talk about in a moment. Those distributions can either be done typically monthly, quarterly, or annually. I would say most common that I've seen and that I've invested in have typically been quarterly distributions, but certainly vary project to project and can be structured much differently. The second way is through principal paydown. So just like any rental property, one of the beautiful things is as you're paying down that loan over the life of the investment, it's typically your tenants that are paying that down through the rent, things like that. So over the life of the investment, that principal balance pays down, and then is realized as increased equity at that liquidation event, either through the sale or refinance. And those profits are distributed accordingly to the limited partners and the general partners. Then lastly is appreciation. And again, in the commercial space, there's really 2 ways that we can get appreciation. One, just like residential, is organic market appreciation. Like we've seen over the last few years, we've seen a lot of this organic market appreciation. But secondly, in the commercial space and in multifamily, you can have forced appreciation through these value add strategies. Commercial real estate is valued much more based on the net operating income or the profitability of the property and of that asset. So as we're able to raise rents, decrease expenses, and increase that NOI, we're able to force that appreciation, and is a big part of the returns that we strive for in the multifamily and commercial space. Just for illustration of that, if you're looking at an 8% cap property, 8% capitalization rate, for every $1 that you can increase the NOI, again, either through increase in revenue or decrease in expenses, it's a $12.50 increase in value of that property at an 8% cap rate. So you can see how quickly and how exponentially you can drive value in the commercial space. So some common return targets and structures of these syndications, again, they vary wildly across different projects, but very commonly you'll see a split of profits between the LP and the GP teams. A lot of times you'll see a 70-30 split. As an example, that means 70% of the profits go to the LP team, 30% go to the GP team. You'll typically have some minimum target returns. Firstly, being that cash on cash return. And what that cash on cash return is your return on your capital through those cash flow distributions annually. So in this case, a lot of times you'll see a minimum target of 7% cash on cash. And that means on average over the life of that investment, you would expect to receive 7% return on your capital annually, just through the cash flows. So if you invested $100,000, you would expect on average $7,000 a year in distributions annually. Secondly, you'll see this IRR target very commonly. This is a complicated formula. It's much more complicated than cash on cash or other metrics. It's internal rate of return. And really this looks at your return on all the aspects, the cash flow, principal pay down, appreciation, time value of money over that horizon. So it's a way to compare it against other investment classes to see if those returns measure up. Typically, you'll see a minimum around 14 to 15% is what we see typically for that minimum. And then lastly, and one of the easier ones to to gauge is this equity multiple. And really that's just your return on your capital in total over the life of the investment. So in this case, a lot of times you'll see a minimum equity multiple target of 1.75 or higher. And all that means is if you invested $100,000, you'd expect to receive at the in total over the life of the investment $175,000, and that's including your initial capital. So an easy one is that you'll commonly see, and we certainly target, is a 2x equity multiple, and that just means over the life of the investment you would expect to double your money. So that's a really easy one and a great quick one to analyze your investment returns. And then a lot of times in these syndications, you'll have a minimum investment. These can range anywhere from 25,000 to 100,000, depending on the asset and the size of the purchase. Typically, those 506C or those accredited investor offerings are on the higher end of that spectrum, and typically you'll see a little bit lower on the 506B side of things, where it's the buddy investment or friends and family. There's no legal requirement that states what these minimums need to be for these investments. Really, the reason those minimums are there is for the general partnership team to limit the number of investors, mostly just for ease of operations. As you can imagine, each investor has their own tax returns, their own paperwork, their own distributions. So if you were to take very low minimums and have 100 investors, that's a lot of work on the back end to manage that then isn't spent managing the property and executing that business plan. So that's generally why those investments are there. But again, they aren't requirements. If you know the sponsors, you can certainly have those conversations to invest outside of those ranges if you're looking to. But this is very typical what you'd see.
Yeah, Brandon, when I first began investing in real estate, you're definitely looking for cash flow. And it was always neat. You do your projection to see how much the property would cash flow on a monthly basis. And then you quickly realize, that principal pay down over the years and how fast that adds up. And then, on the assets that we've sold, you look at the appreciation that's occurred too. And bundling those three together, when you look at that return, it can be neat and definitely solidified why we enjoyed investing in real estate for all these years.
Yeah, absolutely. Yeah, and they're hedges against risk. Each one has its own little piece there. So when you can make returns in these different aspects, it definitely helps hedge the different risks.
Definitely.
Yeah. So what does this actually look like from the business plan standpoint? How do these distributions look? So we've provided here an example investment opportunity. This is just a made up property that we came up with, but it's a good representation of what you might see in a common offering. So for this example, we look at a 100-unit apartment complex with a purchase price of $7 million. That's $70,000 per door. That's another way that you'll hear this expressed very commonly, is purchase price per door, which is just, like I said, that 100-unit at $7 million purchase price. For this, the example business plan here is a very common one. So in this example, we'd be looking at a property that's potentially a little bit older, hasn't had the maintenance kept up, hasn't been renovated, and is maybe low on the rent side from what the market is showing. So this business plan would be to come in and renovate 80% of those 100 units over the first 2 years of the investment. And we would expect in this example of those renovated units to be able to raise those rents by $175 per unit. That's really important when we look at how these cash flows are distributed, and something you really want to understand as you're looking at these. But it's 2 years of that 80% of those units. We're not going to model out renovating all of them. We actually want to leave a little bit of meat on the bone for the next potential buyer of the property at the end of this, so that there's room for them to force some of that appreciation. Overall business plan on this one is to hold for 5 years, and then have an expected sale price of quite an increase there of $11.25 million. Again, remembering that these assets are valued based off of that NOI. So by coming in, putting in the effort and the money to renovate those units and increase those rents, we're able to really force that appreciation and gain that value and get to that $11.25 million sale price. So what this all boils down to, if you look at the bottom of the slide here, just for the overall metrics, we're hitting those minimums that we had just shown. So an expected average cash on cash of 7%, IRR of 15%, and just shy of that 2x equity multiple. So almost doubling your money over that projected 5 years. Now, if you look in the middle here at this table, this is really where I want to point out some things, and had mentioned earlier that like the cash on cash return, these distributions, they may not be flat. It's projected at an average of 7%. But if you look at that line there, your total cash on cash over the life of this would be 7%. But year 1 and year 2, during that business plan execution of renovating those units, some of those units will be down. We won't have units up at the projected rents that we're looking to achieve. So those returns are lower in those first 2 years. You're shy of 4% year, 6% your second year, but then years 3, 4, and 5, as we've stabilized and we've executed on our business plan, you can see those returns are now higher than that projected 7. And over the life of it, you get the total of the 7% return. So really important. I think this gets missed a lot of times, and maybe a surprise to newer investors as they come in, when some of those early distributions are lower than what the projected overall cash on cash is. Then as you're looking down, you can see you get your distributions, you get proceeds from that sale that we're projecting at year 5, and then you get the return of your total and your initial investment. So through all those cash flows, through that proceeds from sale of $57,000, and then the return of your capital, that's where you get that total cumulative return of that $192,000, or right close to that 2x multiple, almost doubling your money over those 5 years. So really wanted to hone in on this and show how that can go up or down. That upper plot here is just another representation of that business plan being implemented, where those first couple years, higher expenses, your revenues are down because you're renovating units, they're not occupied. And in those first 2 to 3 years, you're really increasing that NOI. And then the last few years, you're stable. But that's very typically how these will be structured.
Yeah, and I get that question a lot of how are you going to hit the expected sale price? And as you mentioned, and discussed and described very well, was driving the NOI, that net operating income, and being able to have a proof of concept on those units, and renovating them to get the rents up and increasing that by $175. But then also to leave that 20%, those 20% of those units for the next person. Because once you can prove that concept, somebody else will want to come in there and then purchase them. Not only that, they'll also be able to look at total rent growth over their hold period, and being able to increase the rents while they own that property too, along with achieving and renovating that last 20 units. So by doing all that, you can get to that expected sale price by looking at the net operating income and the cap rate at sale. So great job putting this together, Brandon. This slide really breaks it down nice and easy for all of us to kind of see how those returns work.
Yeah, thanks, Mike.
So how can you invest in syndications? A lot of times we think that you have to have cash on hand to be able to invest in these. And that's how a lot of people do invest in them, which is perfect. They have money laying on the sidelines, and they want to put that money to work in investing in syndications and real estate projects. But one that is oftentimes overlooked is a self-directed IRA. And if you had a previous employer and a 401k there, and you would set aside money while you're employed there, you are able to self-direct those funds. You can work with a company that is able to kind of oversee it. And one that we use is Advanta. And there's many other companies out there that do this, although we do utilize Advanta still. And they're a great resource. They definitely overlook this stuff for you. But self-directed IRAs are really neat. We did, I do have some information on our website, or please contact me and we can get you that information on how you can look into this to see if it's a fit or a match and works for you. But yeah, if you contact any of those groups, they would be more than happy to look at your situation if that might work. There's also the 1031 exchange, where if you're looking at selling a property, you may be able to sell that and purchase a like kind. There's definitely some criteria that needs to be followed there. You can't just sell it and then later on down the road look at buying something. You definitely have to have stuff identified prior. And like I said, there's a lot of criteria that goes into it, but it can be done. In regards to investing in a syndication, if you're going to be selling a single family home that you rent, depending on location and the value of it, typically the exchange needs to be close to $1 million in order for it to work, with the extra paperwork and legal documents that need to be done to invest those funds into a syndication. There's also the HELOC, a home equity line of credit. A number of us have equity built up in our homes, and we wonder how we can utilize that again to grow our money instead of it just lying there. And you can definitely use those funds to invest in a syndication, but we want to strongly recommend that you review the documents and see if it's a fixed rate HELOC or if it is a floating rate. With the interest rates where they are today, it may not make sense to hedge and try to arbitrage that distance in the rates. But if you do have it locked in, it may make sense. So it's a thought to look at, but and something that we wanted to just to throw out there as an idea, but definitely know the fine print of that HELOC before you do so.
Yep. Yeah, they're great. They're a great tool to use when appropriate, but certainly come with their own sets of risk. And then I want to reemphasize that self-directed IRA, because you're right. It is one that gets very commonly overlooked, and certainly worth exploring more if you do have those. That is how I got started in real estate investing in general, both in the single family space and in the multifamily space. So I've certainly benefited from it, and certainly have gotten better returns than what I was getting in my 401k. So certainly something to look at there.
Yeah, definitely. In regards to the tax benefits, here too, even if you have your own single family portfolio or commercial buildings, whatever you might have, those or investing in syndications, there are similar tax benefits. And again, here too, we want to make sure that you seek CPA advice, because again, the tax benefits aren't the same for everyone in all these projects. But there is a typical depreciation, and there's the straight line method where you take that asset and deduct the land value, and you can depreciate that out over 27.5 years. Or that's a residential side. On commercial, it's 39 years. There is also the cost segregation, and this is where we are able to take the components of a commercial building and accelerate the depreciation of that. And we did a webinar with Jody Nielsen, and she broke down what a syndication is and explained it really well. And the example that I like that she has is looking at the Big Mac. You do the straight line method, the hamburger's $3.99. When you look at it through the lens of a cost segregation, there's two patties, there's the sauce, lettuce, ketchup or cheese, pickles, onions, and the bun. So there's a lot of aspects to it. They all have different values. And if we want to flip that to a syndication side or a real estate side of things, they depreciate out over a different time frame. So we look at a building, we have flooring, appliances, lighting, sheetrock, and that can all be depreciated out over a different time frame. So a lot of things can fall into that 5-year bucket or a 7-year bucket, maybe the 10-year bucket, instead of over 27.5 years. So you can really shorten and take advantage of those depreciations a lot sooner than later. And then we also have the 1031 exchange. Again, this is where you are able to, sell an investment property and buy another one without needing to pay the capital gains up front. Those can be deferred for down the road. So that can be a significant savings for individuals also.
Yeah. Yeah. And on the tax side of things, this is one of the reasons so many people really look towards real estate. It was one of the first drivers for me to start to look towards real estate as I grew within my career and saw more and more of my dollars going to the government. I started to look closely at ways to reduce that. And the tax law is really written to incentivize two things: providing jobs and providing housing. So investing in real estate, that tax code is really written to benefit those that invest in real estate and provide housing. So it's a great place to shelter your funds.
Definitely.
Yeah. And so we've touched on a lot of these things throughout this presentation, but really wanted to recap this with, if you're considering investing in a syndication, what are the things you really should be considering as a passive investor? Again, on that sponsor and GP team, you want to know, like, and trust them, and you really want to do your due diligence on that group that's managing the project. What's their track record? Have they invested in similar asset types and execute on similar type business plans? Have they successfully exited any of their previous deals? If you don't know them, or even if you do, you may want to run a background check. You can certainly do that, and definitely get references from past and or current investors. Again, ask them how those investments performed compared to what the business plan was. How was that communication? Was it regular communication? Were they providing updates both on the positive and, again, on those challenging times when things don't go to according to plan? But definitely put in the time and effort up front. Again, limited time, minimal time as a passive investor, but certainly not no time as a passive investor. Then next, understand and research the investment strategy and the business plan. And then does it meet your risk profile and your investment strategy? Is it a value add project where a lot of those returns come on the back end? Or is it a higher class asset that typically is stabilized in a long-term hold with consistent cash flows? Those strategies are different. They have different risk profiles and they have different return profiles. So be sure that you understand those and that they fit your goals and your risk tolerance. Understand the deal. You don't have to be an expert underwriter. That is the GP team's job. That's what they get a cut of the proceeds for. But you certainly want to understand the basics of it and understand the business plan, and make sure that you're comfortable that the business plan and the underwriting they put together, that you're confident that it'll result in the expected outcomes. Ask questions like, what are the fees? How and when are they charged to the LPs? How were the projected rents, vacancies, and expenses determined? This is really big right now, where over the last several years, we've seen this steady and sometimes very drastic rent increases. And we're starting to see that change, where some major markets are flatlining or even declining right now. Vacancies are starting to come up a little bit in some markets. Expenses are changing. Insurance is a big one right now. Taxes. Really asking and pushing on that GP and that sponsor team to provide good detail as to how they projected those and came up with those. What stress tests have they performed? A break-even analysis, where that is where they look at what is the minimum occupancy needed in that property to be able to maintain operations, pay the bills, pay the debt. What's that minimum they need? And then a cap rate analysis. If the market shifts, what does that do to the returns? And what kind of cushion and contingencies do they have built into that? And then lastly, ask, how are distributions accrued if there's a shortfall? If there's a preferential return or any returns and they have a shortfall, how do they make that up? Do they plan to make it up? And when does that get distributed? And really all this boils down into evaluate the risks. Again, while real estate investing is generally considered lower risk, it's not no risk. So you need to ask yourself questions such as, if I lost that investment, would I still be financially secure? Remembering that these funds it's not a liquid investment. So those funds are tied up through the life of that investment. And if things do go south for whatever reason, you may lose some or all of it. So you want to make sure that you're secure if that happens. With that deal, know, like, and trust your sponsor and GP team. Again, we've hit on that several times, but definitely make sure that you're comfortable with that group. And then even if you're comfortable with the group and you trust them, make sure that you're also confident in that property, in that market, and in the business plan for the long term. It's one to know and trust the partners, but if it's a poor project, that's just as bad, and vice versa. It could be a great project, but if you don't trust that sponsor team, that it still could go south. So you want to make sure you are confident in both of those aspects.
Yeah, no, that's great, Brandon. And you're right. These are all things that that you should definitely consider, because again, it's your money and you're investing in that team, and hoping and wanting to make sure that they are able to execute that business plan. So you definitely want to ask these questions, and then, as we said before, get to know, like, and trust them. If you have any questions, please put them in the comments, and we will definitely answer those. And as I mentioned before, we're going to be doing a series of these webinars, and we will definitely send out more reminders of when they are to come. But no, we're looking forward to doing 3 more of these over the next few months. So please definitely watch your inbox, and we'll get some more of these put together and share them with you. But one question there is in regards to fees and how they are structured and looked at in the syndication. The fees vary. If you work with a number of different sponsors, you're going to see different fees from different groups, different percentages. But one of the most common ones is an acquisition fee. And a lot of times, depending on the size of the project, it can vary really from 1% to 4% is what I've seen. Again, if you're looking at a $25 or $40 million project, it may be 1% or 2%. If you're down in that $3 million range, it could be closer to that 3% to 4%. Then there's the asset management fee. And again, that's the fees for making sure that the business plan are being met. Sometimes, depending upon how the offering is laid out, there may not be an acquisition fee if you don't hit your preferred return first. So then not always the case, but there can be different stipulations within those fees and how they're laid out, and when that GP team is able to get some of that. These fees are a lot of times when are baked into the underwriting. So when you look at those and over the life of the plan, it's built into the returns that are projected at the end. So if it's still a 2x multiplier, these fees again are rolled into that. Every once in a while, you'll also see a disposition fee, or when it's sold. That's the time when you're working with the getting all the legal documents and your information to get this property closed at the sale. There can be a disposition fee. Again, these fees can vary and be different from project to project. It's not like they're all in every one and they're all the same percentage. So they can vary greatly there.
Yep. Yeah, and that's a great question. And really one of the questions that I usually get as a follow-up to that in a lot of the conversations I have is why does the GP team need those fees? And it really comes back to the overall structure. If you remember earlier when we showed, a lot of times these splits are 70-30, sometimes 80-20, where the majority of the returns throughout the actual execution of the investment are really going to the limited partners. So throughout the life of the investment, very little typically ends up going to that GP team. So it's to pay for the GP team up front, putting in that effort to secure the acquisition, so that they actually have those funds throughout the life of it. And then that asset management fee, yeah, it's paying for flights and things like that, but it's not just a big slush fund. It is certainly again baked into that underwriting. So all those returns include all of that.
Yeah, that's a great point. And I was even thinking the acquisition fee too. Yeah, it's amazing how many properties you can look at and underwrite and meeting with the brokers, being there, looking at different properties and getting them close to the finish line, and then they don't happen. There can be a lot of time spent. So sometimes those acquisition fees do look fairly large, and but they do get eaten up pretty quick. And a lot of times it's also distributed, throughout that GP team. So it ends up being a pretty small fractional amount for each person.
Yep.
Another one you have here is cost segregation. And if we've ever done a cost segregation analysis before, and I have, the last ground up construction project that we did a cost segregation analysis on that. And for me personally, in regards to the tax purposes side of things, it worked out very well. And it was very painless, really. We hired Jody Nielsen and her team to do that for us. And again, we provide them building plans. They actually come on site. They take pictures, look at the property, and they put all this together, do an engineered report, breaking down everything within it, and submit that to our CPA, or to us and our CPA. And on the tax side of things, it was a great benefit for us. We were paying fairly significant quarterlies, and by doing this cost segregation, we were able to wipe out all the income from our other rental properties. So the other ones, even where we have depreciation and all that, although the income on side of that as a passive or on them properties were higher, but we were able to wipe that out. So we were no longer required to pay quarterlies. And that was for 23. And the projected for this coming year, was the same scenario, or maybe, sorry, 22, 23, but not needing to pay quarterlies, which is huge. And again, these are dollars that I'm able to save and not pay in on taxes, and do what the government is asking for, able to reinvest that into additional rental properties and provide housing for people.
Yeah, great points there, Mike. And one thing just to point out, I have only been through one cost segregation property where we included that, and it was while I was an LP, and it was a property that I actually leveraged my IRA, my self-directed IRA, and because those are already tax advantage dollars, you don't get those benefits from that if you're using retirement funds. So just one thing to point out there, or if you're expecting that, but you're using those retirement funds, you don't get to participate in that, but still a really positive thing in any project.
Yeah, no, and that's a great case in point. The self-directed funds, it's already tax advantage, so you can't utilize that. So when you do look at, or if you do invest into a syndication, it is a good question to ask your CPA up front. If you have other passive income, can you offset that? What if I don't have any other passive income though, and I just have W-2? Can I utilize losses on a K-1? It'll vary greatly for all of us, but definitely worth the conversation with your CPA, because in some instances, you may have thought of investing 50, although if you can see a significant savings on your taxes by the loss on a K-1, that may change your mind and want to invest more to wipe out to wipe that out and bring it back to zero. But again, talk to your CPA, and they'll definitely be able to help you out there. With that, I do not see any other questions. But again, I want to thank you for taking the time and joining us. And again, mention that we will be doing some more of these, and we look forward to bringing you guys more information about syndications. So please watch your inbox, and until next time, thanks again.
Yep. Thank you, everyone.